Well, Singapore is not expecting a technical recession. That's according to the Trade and Industry Ministry. A technical recession, well, it happens when there are two consecutive quarters of quarter-on-quarter economic contraction. Although the economy did shrink on quarter from April to June, MTI projects positive growth ahead. However, it trimmed this year's growth forecast as the global economic environment weakens further amid inflation and supply chain disruptions. Brandon Tanotto with more.
Singapore's growth this year is expected to be between 3 and 4%. That's a touch lower compared to the previous 3 to 5% forecast. The country's external demand outlook has weakened compared to 3 months ago. Supply chain disruptions are also likely to persist for the rest of the year, given the global economic risks.
These include further escalations in the Russia-Ukraine conflict, which could exacerbate inflationary pressures and dampen global growth even more. Risks to financial stability if there are disorderly market adjustments to monetary policy tightening in advanced economies is another risk.
Economists also believe that geopolitical tensions over Taiwan could have a double-edged impact on Singapore.
Taiwan is a major chip maker, and that could kind of affect Singapore as well, given its role in the electronics manufacturing supply chain. But having said that, the conflict could also result in some diversion to Singapore. For instance, travel and tourism. Even on the electronics side, I think Singapore could potentially see some benefit if companies decide to order from Singapore instead of Taiwan.
Higher inflation is another risk.
The current quarter should see the peak, but how much does it and will it ease off from there remains to be seen. When will we get down to that 2%? I think there's still some way away.
In fact, Singapore Prime Minister Lee Hsien Loong in his National Day message earlier this week warned that low inflation levels are unlikely to return anytime soon. Meanwhile, second quarter growth came in at 4.4% on year, down from the earlier advanced estimate of 4.8%. Singapore's outward-oriented sectors like chemicals and wholesale trade are facing a dimmer outlook. That's given the expected weakness in China's economy, which is a key market for petroleum products. Aviation and tourism-related sectors, however, are expected to bounce back strongly as borders reopen.